Was goody fam. We were initially planning on dropping a John about Korea's upcoming application to upgrade their MSCI status to developed rather than emerging market, but given how much time it'll take to get that ball rolling, we figured it's best to focus on what's going on right now. For that reason, we've chosen to take a look at KDI's monthly economic trends publication released on the 7th of this month. You're watching Seki들, and this is the Bear Bull, aka what's going on in our economy at the beginning of December 2021. Now before we continue, I'd just like to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice from a paid professional. When it comes to investments, it's always healthy to take everything with a fair bit of skepticism regardless of the source, and that includes us, so for that reason, nothing we say here should be taken as a basis for investment, and you'll have to do your own work and thinking before deciding whether taking up a position on any stock that we mention here is in your best interest. Want to know how? Well, if you just scroll down a tiny bit and hit the like and subscribe buttons, we'll do our best to help you figure out how to figure out this game for yourself. And with that being said, let's get to it. So let's start with the bad news, because why the hell not? Now, in spite of the improvements we're seeing in a number of sectors, including industrial production, the service industry, and less flashy things like equipment investment, the Omicron breakouts and continued spread of the other editions of the coronavirus have been threatening the rate and stability of our expected recovery. With over 5,000 cases coming in on the daily after a sustained run of 6 to 7K, it seems as if the rush to reopen has led to a predictable spike in hospitalizations. According to the Korean Herald on December 12th, bed shortages hit a critical level across the country as over 80% of all ICU beds were filled. In the past weeks, nearly 30 people have died at home due to COVID and a lack of availability of beds. In spite of this, the Moon Jae-in administration has been resolute in their stance regarding reopening, with no intention of reverting back to lockdown measures, although some social distancing rules have been tightened in parts of the country. There were also reports on Tuesday that the admin was thinking of toughening restrictions once again, but they also said they'd watch what happens on Wednesday and Thursday, that being the 15th and 16th of this week, and adjust accordingly, but we'll just have to wait and see what that actually means. Now, in addition to the effects that we're feeling locally, there's a significant pressure being placed on consumer spending globally due to a number of factors, including but not exclusive to the continued strain on global shipping companies due to a sustained high demand and lack of ability to clear ships in a timely manner, which applies to the US and China and a lot of major shipping hubs, and the resulting inflation born of those strained supply lines, a continued premium on oil, a retightening of COVID measures due to the Omicron breakout internationally, and continued production delays in major Asian markets like China and Japan are all really frustrating factors when it comes to economic recovery. To make matters worse for global shipping, in an effort to keep COVID out, foreign merchant mariners in China are no longer allowed to do crew changes, while Chinese merchant mariners are being subjected to 7-week-long quarantines, meaning turnaround times in and out of China probably won't be easing up for the time being. And given that China is the world's biggest exporter, that's a pretty worrisome thing. For this reason, the external conditions are showing downward pressure in light of Omicron shipping and a rising non-transitory inflation. Now locally, the CPI, or the average consumer price of products and services, has risen by just short of 4% on the back of supply-side factors like oil and agriculture, while interest rates continue to rise and the stock market has stayed vacillating between 2,900 and 3,100 for the past few weeks. And although a higher interest rate usually means something good for us since we can get more from our savings, it also means that people that were on variable rate loans are now having to pay more, and it could possibly be putting a strain on people with larger loans than they were ready to pay for. Hopefully this hasn't made you too sad, but generally the outlook isn't really peachy. Still, with that out of the way, now we can actually get to the bright spots. Now, the brightness of all of these spots are a little dimmer considering what we just listed above, but that could very well provide a little more context for a weird bear bull market that we've seen over the past few weeks. So let's start with the local supply side stuff. First, employment has continued its uptrend in growth in both the service and construction sectors, and although manufacturing jobs have continued their decrease, the numbers fell from 37,000 jobs lost to 13,000 jobs lost between September and October, which is pretty good. And in addition to this, the total wage for regular workers and temporary workers both rose by just shy of 4%. And that mirrored the overall inflation and hopefully made dealing with our current inflationary effects a little bit more manageable for those workers. Now, exports are continuing their growth up 8% from the previous month prior to the Omicron thing, And although our export growth rate is much lower than it was during the peaks of June and July, they're still significantly higher than where they were prior to the corona at the end of 2019. Finally, one thing that I like to watch as an investor is the amount of capital expended on equipment and machinery investment, as during down periods such as this, it's nice to know that firms are taking the time to improve their foundations and expand in equipment and capital goods. As we noted in a past video, the rebound we're seeing in semiconductors is a main driver in this respect, driven by new orders of specialized industrial machinery for that sector. Given the importance of the semicon space for our economy, this is a very good thing to be seeing. However, another one of our major industries, automotives or automobiles, has continued to eat dirt due to the continued chip shortage. Still, with the overall inventory to shipment ratio jumping further, sentiment is dampening around the potential continued growth of exports in the midterm. And with all that said, here's where we're at. Services are coming back strong under the government's With COVID initiative, meaning both employment and consumer spending on services are finally starting to recover. On the other hand, corona cases are still spiking and ICU beds are in perhaps the worst place they've been over the course of the pandemic, at least in Korea. Next, corporate investment is up with regards to machinery and equipment, which is great to see, but inventories are starting to pile up, leading to a reduction in manufacturing and a continued shedding of manufacturing jobs. In all, there are so many reasons to be bearish, with a significant number of reasons not to be, leading me to the conclusion that my therapist is wrong, the bear bull is real, and the bear bull can hurt you. Or at least it can throw a cloud over everything you think you know. Alright, that's it for me. Sorry for the delay on this video stuff, but I will try to get back up on this horse as soon as possible. All the best, stay safe, be easy, peace.